Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for June 4th of 2023. From the chart back this week, want to focus on the labor market data that we got. May jobs report was released this past week, and maybe a little bit confusing. As you can see here, we did have the unemployment rate which moved higher from 3.4 to 3.7, but the labor market still remains pretty strong. We do see layoff announcements, so we've got some charts on that. Do see some kind of like, I'll call it chinks in the armor there for labor, but we had a payroll jump in May of 339,000 from April, and then we also had an upward revision in the prior month's data, and so that's basically double what was expected coming into this release this week. And then we saw the household survey. We've got some ADP data coming up, and we actually showed actually a little bit of a downtick in employment. So, it's not completely, alien to have such, kind of like divergences, so to speak. But, labor market still remains relatively tight here. And I guess there is a difference between being tight and being necessarily strong, and as you can see in the coming charts, we have some stressors on small business that I think will begin to emerge. You'll look at hours worked. We'll continue to see that probably migrating down amidst some pockets of unusual strength, but overall we do see labor probably beginning to moderate somewhat, which is essentially what the Fed wants in its rate actions. And here we have average hourly earnings for several different cohorts within the labor market. We've got non-managers on a 12-month basis, which is a little bit more smoothed out. You can see on a 3-month basis where it's ticking up a little bit. So you look at all private jobs, you can see the general trajectory moving lower. But you do see that kind of attenuating a little bit. So that decline is attenuating. Is it beginning to level off? And then, of course, on the 3-month survey here, it's actually ticked slightly back up. And here we have the components of the change in employment of that 339,000 jobs. You can see that disproportionately healthcare, government, professional, technical, in the hospitality area, food, construction, and we'll see this in a second. Oddly enough, construction is relatively strong at this point, considering the fact that we know that except for industrial, we do see a lot of weakness across the board in non-residential construction. So here we have retail, trade, real estate, management basically being flat, but then manufacturing, which we know is in a bit of a sector recession already, if you will, and then technology, and you'll see that manifest a little bit later when we see the Challenger Gray numbers. Here is the labor force participation number for the prime working age, 25 to 54. I'll note here that that this number, the blue number that represents those that are in the labor force, has exceeded pre-pandemic levels, which obviously is something that we want. Now, if you look at the overall participation rate, it will show that the older age cohorts have left the workforce and in many respects are not coming back. And so overall participation is a bit more muted than what you see here, but importantly, this represents the prime working age folks in the market. Here we have the ADP data. This is private non-farm employment, so this usually will foreshadow some of the overall labor market data. Again, ADP is a private firm. Oftentimes, though, it does show a bit of a deviation, differences in how this is calculated, but this clearly shows a divergence here in small firms, which I think could be a bit temporary based on some of the credit issues we'll look at in a second. But oddly enough, you see large firms very much in decline. That's actually been pretty well advertised for a number of months now. But small company data is a bit mixed here because we've got some funding challenges. We're going to see in a second how credit is really tightening up for the small business market in terms of expansion capital, in terms of rolling over existing debt that is maturing this year, and we have a lot of that maturing this year. But here, it's at least in a microcosm, you can see labor market amongst the small firm cohort is still relatively strong. Here we have the Challenger Gray numbers. These are announced layoffs, and this particular reason is due to closing. These are businesses that are actually folding up the tent and going away. And you see this fairly strong uptick now. To be reported in the Challenger Gray numbers, I mean, you tend to have to be a bit of a larger firm, and so this certainly captures like Fortune 1000 firms that are making public announcements, news releases on these types of things. And so this is captured in that. But you can see a fairly strong spike here. Here we have construction industry employment. And I'll have to say that I'm a bit surprised that this number continues to be a real source of strength overall in the employment data. Obviously, the cost of construction, the cost not only the cost, but the availability of credit, as well as the interest in advancing certain types of commercial projects, would normally cause me to think that this number would roll over, and maybe it will. But obviously, as I mentioned before, industrial remains fairly strong. We do have residential construction that is moving forward in many markets because of an undersupply and high prices still, even though they've come off their peaks. But construction industry employment is still pretty strong. We have average hourly work weeks for employees, and this is private sector. I see that this trend line continues to move down. And so what this is an indication of is that in averages, when you talk about downturns, average work weeks will go down as you're trying to keep people on staff, but you're trying to mitigate their workload to meet declining demand. Of course, the story that's not being told is which industries are most exposed. And I would hazard, obviously, manufacturing. We just saw that, and we'll see the ISM numbers for manufacturing coming up, which will definitely paint that picture. But usually you see this as you're heading into a recession. You have a deceleration of hours worked, and this is kind of like the last stab before people actually get laid off, as you try to mitigate their work weeks to match your demand. And then at some point your demand is your slack is built up enough that you just have to start laying people off. And of course, we just saw from the ADP number, small firms are still hiring. So these two numbers kind of are working against each other to some degree, but this average work week number is across a wide swath of size and other factors that kind of smooth out the overall number here. And here we have job openings relative to unemployment levels. And as you can see that this number inflected back in 2021 and has remained somewhat consistent, if not slightly, erring to the downside, both data series here over the last year or so. And so, but it remains stubbornly consistent in the sense that, we've got, about, 1.6 jobs for every unemployed worker, and in that level, and it's remained, as I mentioned, very consistent. So these are mostly low and semi-skilled workers. You think about busboys, cleaning people, those types of folks, and it does get up into some higher skilled tiers as well. But when you look at it, that there's a multiple of openings for every unemployed worker. And this is one reason why the labor market remains stubbornly tight despite the Fed's best efforts to try to soften it up. And it's another reason why wages are stubbornly high at a point where, it is still a prime input into not only service inflation, but overall inflation that the Fed is trying to tackle right now. Home prices and incomes is something that a lot of people have studied over the last several years. And you can see in this chart that we have never been at these levels. I mean, even going back to the global financial crisis, we've eclipsed that level. And just think about the mathematics of this. So you take a home price, average home prices, and you divide that by income. And so this time series here, which dates back to the World War II or post-World War II, you can see how it's migrated over time. And this level represents a pretty astronomical rate of change in a relatively short period of time. Obviously we've seen home prices really accelerate, and recently they've come off their peak, but they're still relatively high as it pertains to income. And so this really underscores the affordability issue that, and I'd use this as a kind of a watermark to say that you could build a lot of houses, you could construct a lot of shelter here for folks, and it's going to take a lot to move this needle down. It's going to take a lot of inventory to get these prices down. And we know in an economic slowdown, incomes are still high, but they are coming off their peak. So you're going to have a challenge in this equation. Not only are you going to have to try to mitigate prices, but you're also going to have to try to maintain incomes, which are going to be exceptionally hard to do in a slowing economy. Another thing that we need to be watching for very carefully as we head into the end of this year, beginning of next year, in the economic data is a student loan repayment moratorium that we have had in place since the pandemic, and that is now officially going to be ending at the end of August per the debt ceiling negotiation. So that was something that President Biden was not willing to fall on the sword for, and so as a result of this agreement, which will be signed into law to extend the debt ceiling, that student loans are going to have to start being repaid again as of September. And so when you think about the lower age cohorts where all of this was put into forbearance for multiple years, and people got used to that, and now they're going to have to include that in their budgets. And I do think that probably accounts for, I'm going to call it maybe 0.5 to 1% of GDP impact, meaning that GDP, economic growth, will be probably about 0.5% lower as a result of all this. Here we have meat prices that have gone up. Well, we've been talking for the last several weeks about various commodities. We talked about corn going down and other grains and things like that. There's an interesting dynamic here, particularly on the beef side, but you can see here in the gray, there's also pork and chicken that are impacted. They're relatively high, maybe chicken, stabilizing a little bit. But if you look at, a multi-year trend line, that's clearly moving higher. Now, one thing that's going on in the beef market is the herds are thinning, and the cost of maintaining a herd, which doesn't get a whole lot of press, but I was reading an article in the Wall Street Journal, which is where this particular chart came from, that the cost has moved exceptionally higher. And so when ranchers are, basically sending their herd to slaughter in the current season, they're less inclined to want to restock that herd due to the higher prices. And so obviously it's a give and take because they need the income from the animals, but the cost of that is going down, and so the returns have changed over the last couple of years, the last year in particular. And so I would expect to see, as a result of that the beef prices, and we do love our beef in this country, that beef prices and perhaps even chicken prices to some degree are going to remain relatively high. Now we'll start getting into some of the economic data, maybe as it pertains to small business, the credit markets, so on and so forth. And then we'll transition over into the equity market, which I've got some interesting slide this week. So, let's start off with what we see. Private company defaults have moved noticeably higher. You can see they've moved higher than during the pandemic when we had an economic shutdown. You can see the public announced defaults are actually moving higher as well. And so, when you think about this, then this is driven by economic conditions. It's driven by the availability to, roll credit and refinance debt, and obviously it has a lot to do with your operational sphere of influence. Where your economic moat. Your markets, your end markets, your customers, the health of all of that matters, and it all plays a part in this. But you can see the dramatic rise in defaults, which I think will become more publicly acknowledged here in probably the next several months. That this is a real issue, and it's going to stymie job growth at some point. We've been talking about the labor market being strong. Well, at some point, if you have enough of these defaults, it's not only in a real sense, you have literally fewer companies to hire and expand and and make capital spending plans and build those expectations, but you also have this kind of like psychological influence of other companies saying, well, wait a minute, I might need to tap the brakes. I see all these other companies going into a default. I'm going to tap the brakes on what I'm intending to do, at least for the time being. And I think that kind of can settle in. And honestly, I'm beginning to think that due to the strong labor market that we saw, which I think kind of delayed the entry into this recession by probably 6 months, that it might cause us to have some weakness extended to the beginning of 2024 at this juncture. Here we have the median interest rate on variable rate loans to small business. So as we're talking about stressors for small business owners, this is most certainly one. You've got regional banks that tend to do a lot of this type of lending, certainly on a C&I, consumer and industrial loans. And, as we've talked about over many months now, that we've had a flight of deposits from the medium and small and regional banks as a result of a lot of things, but notably what happened to Silicon Valley Bank and its peers that actually were set to fail before the Fed stepped in and basically bailed them out, the Fed and the FDIC. So anyway, so we've got stress in the middle banking markets, so they're charging higher rates, to meet their risk-adjusted returns, and they're being much more persnickety on the loans that they are making, and credit is just overall tighter. And if you're a small business owner and you look at this chart and you say, well, my funding costs have gone up appreciably in a very short period of time, not only are you less inclined to want credit, and we're about to see that in that chart, but you're less able to get it. Here's the chart that I was referencing before. You've got loan costs moving higher, that's in the red, and then loan demand moving lower. And these tend to work in opposite, as you might well expect. So we have seen a noticeable drop in loan demand. And so think about the implications of that, just as I've alluded to in these prior slides, is small businesses want capital to help them expand, use other people's money to grow their business, pay back the loans, move on down the road. Well, if your loan costs are moving higher, you're less inclined to want to take the loans, and as a result, you're less inclined to be able to grow. And I think that's exactly this kind of mentality, not just a mentality, but this kind of backdrop that's settling in here, heading into the second half of the year. As we look at auto loans, a different kind of loan. This is consumer, and so it's not necessarily small business, but it's it's all kind of moving in the same direction. These loans are getting tighter to get. So I'd say lending within the auto loan market is getting tighter. That's probably a better way of saying it. But you see most notably the decline in the super prime level. These are the best, most credit-worthy borrowers that you have, and you see that auto loans from non-bank lenders, again, these are from sources other than traditional banks, but it paints the same picture. And you look at all the way down to subprime, all of this is rolling over to some degree. Here's a chart from BlackRock, which I thought was very interesting. It does an overlay of manufacturing, which we know is slowing. And you can see here the Institute for Supply Management, the Purchasing Managers Index here is below 50. So again, to remind all of you that any reading below 50 represents contraction. Any reading above 50 represents expansion. So we are in contraction now. And so as we've done in other views and other charts, we kind of overlay the recessions with these trends in PMI. And so what BlackRock has done here is they have made the assertion that you can have a negative or you can have a contractionary PMI number, but when it gets down to 45, that tends to be an indicator, a pretty strong forward-looking indicator, and actually to some degree coincident indicator of recession. And so we're basically at that point now, and you can see that in prior periods where we have, where we have touched that point, have either been a true recession, 2001 and 2008, but also it encompasses the soft landing that we were able to engineer in 1994 when we had multiple rate hikes in a row, not unlike what we witnessed last year. Here we have the ISM manufacturing PMI, again, looking at it in kind of a different light. And time series, it doesn't go back nearly as far, but it gives us a vignette to several aspects of the PMI. And so we've got the overall index, which we know is in decline, showing contractionary conditions. We see new orders and backlog of orders, and we'll see this again in a second, which they're all in decline right now, and this is pretty impactful. When you look at backlogs, I mean they're as low, they're actually lower than what we saw even in the pandemic. During the shutdown, and that's pretty notable. And so, backlog and new orders are still pretty low. Again, this is manufacturing. We have seen quite a inventory drawdown happen on the retail side as it relates to services. So, in a different vein, we've also seen backlog and inventories move lower. But unfortunately, the element that's kind of settling in now is that you've got demand, which is beginning to drop off in these various categories. And so your new orders is falling concurrent with your backlog. So here's the breakout of these. You can see on a trend series, the overall PMI, again, to emphasize the point, in contractionary territory. Saw that back actually at the end of 2019. So those of you keeping score, long before anybody was talking about coronavirus, we were actually in a contractionary environment for PMI. And then if you look here on new orders in the upper right, and then the backlog as well, just breaking out that number we just saw, probably more for emphasis than really anything else, that the direction of these trend lines pretty powerful. The fact that they're all negative is pretty powerful. Backlog being below 40 is particularly powerful, because this is your future revenue visibility for a lot of manufacturing firms. And so, this idea that we're in a manufacturing recession right now is actually very, very real. Now we're going to switch over to the stock market and just talk about this absolutely nutty divergence and this thin leadership in the market that we've witnessed. Really, I'd say year to date, yes, but much more so since we had the Silicon Valley near-death experience here, and you can see that in the left-hand side. You know, and if you look at the S&P 500 overall, which is kind of that dark green. Obviously, we've meandered higher this year, but the green line, the lighter green line there represents the S&P 500, excluding what they're calling at BCA Research, kind of the AI thematic stocks. And so, you know, we've been talking about like the Fab 5, which account for about 25% of the S&P 500, have been leading the market, and the equal weighted S&P 500 index has really been treading water, if not like slightly below, slightly negative return for the year. And this is a very kind of comparable proxy to that. So they're backing out a lot of these stocks that are really kind of playing into or perceived to be a part of this whole artificial intelligence or AI movement. And you can see IBM's in that, Adobe Systems, Arista, Accenture, and they're in the consulting space, consulting on AI. So they're casting a wider net as far as this exposure to AI that's really caught this bug. And so, you know, that's what they're trying to tell in this story right here, is that those AI stocks, and again, the core technology stocks that we've been talking about, you know, Apple, Google, and to some degree Meta, you know, they're all, you know, a subset of that. These have been the high flyers of the year, and these stocks right here, the AI stocks, are the reason why the market is up. And if you take them out of the equation, you can see here that we're treading water. On the right-hand side, just again for emphasis, you can see the weekly inflow into technology stocks. You see tech flows and billions of dollars. This is from Bank of America and their global strategy work, which is as good as the BCA work that I referenced here on the left-hand side. But what this shows us, you know, pure and simple, is that you've got a lot of people that are trying to chase the caboose on the train. So you've had this divergence. People are, you know, these are pretty sexy returns that people are looking at, and it's all driven by very, very narrow leadership. Whereas the average remaining stock in the index, as I mentioned, is trading water. People want to be involved in that. So you've got tech flows. We'll see in just a second. Retail flows are really picking up too. That's just like the average investor and their Robinhood account are playing some of these names. And so we've got a lot of money that is kind of like late to the party chasing these returns. And that's usually a contrarian signal, or at least it's a signal that we're apt to see some increased volatility at some point. Here's a chart of retail net purchases. Now this encompasses all U.S. Equities, listed equities on the publicly traded markets, and you know that number is in the green. You can see the S&P 500 index kind of superimposed on top of that. You can see obviously the declines as we entered that kind of that really uncertain weekend with Silicon Valley Bank and whether they're going to get bailed out. And so obviously markets moved higher, but correspondingly we've seen a little bit of late pickup here in retail net purchases as people have kind of jumped back in with some liquidity trying to chase these returns. Now we're going to switch gears, stay in the equity market, but a couple of things that, you know, at least from a valuation standpoint, that are a bit giving me some pause for, and maybe a little bit of cause for concern here. So on the left-hand side, we've got the equity risk premium, which mathematically you just take the earnings yield, so earnings divided by price. And we know that earnings are a little bit challenged right now and apt to go lower. In some areas, lately we've seen some estimates move higher on earnings, and I think maybe a little bit short-sighted. But anyway, just call it, earnings are in question. Let's just leave it at that. So you take those earnings that are in question and divide them by the price of the stock, or in this case, the index, and that gets your earnings yield. And then you subtract from that the 10-year Treasury yield. And so right now, that number has moved pretty low. And so the delta between those two is not that great. And you would want to see that higher if you're in a healthy equity market. So right now, the earnings risk premium is pretty low, which means you're not really getting paid for taking on the additional risk of the equity market. And on the right-hand side, we have the NASDAQ 100. These are pretty large, in many cases, technology stocks. And you can see the relationship of that forward price to earnings ratio to the 10-year TIPS yield. And that's the Treasury inflation protected security yield. And you can see the tight relationship here. And what this chart shows you is there's been a fairly strong divergence even before the year started, between these two data series. And so this indicates that, that the market is overvalued as it relates to the 10-year Treasury, which we know is, maybe a bit suppressed right now, and inflation expectations are what they are, and inflation's still relatively high, but you've got valuations that are much higher than they should be empirically, given the level of level of inflation that we have. Another chart from BlackRock, we'll talk a little bit about kind of strategy here. And so, this is a little bit of a dissection of the index itself. And so I've talked a lot over the last several weeks about how the index is constructed, and honestly, how I feel like the equal weighted index is a much better barometer of how portfolios are actually being structured right now. Unless you're a money manager that is putting all of your money into these high-flying technology stocks, you don't look like the S&P as it stands right now. And so you see the construction of the index is very much growth oriented. And so when you think about that, you've got the derivation of those stocks, of those growth and value stocks on the right-hand side. A lot of the familiar names that you certainly know. But when you think about the current backdrop, which is perhaps a little less favorable if you're going into recession, it's certainly less favorable for growth stocks than it is for value. Capital strength, dividend are those types of factors that tend to perform very well, not only during bouts of volatility, but also in recessionary periods. And so you've got an S&P 500 that is predisposed towards growth relative to value in terms of its construction. And again, I just highlight that to say that, with the valuation data that we saw on the prior slide, the risk premium data that we saw on the prior slide, that it would not at all surprise me that that given the fact that the S&P 500 is a more growthy index, that it just helps to exacerbate the potential for volatility. And we have another chart from BlackRock, and this talks about different factors, and primarily focusing on the quality factor here, which we've talked about a lot, and how it relates to our portfolios. And you look at cumulative returns, following the cessation of Fed rate hikes, which I do believe we're at that juncture now. Now, Fed has kind of held out the potential for future rate increases after this pause, or this prospective pause here at their meeting in June. But if this is the end of the rate hikes, and forget about this conversation about when they're going to start lowering rates, because I don't think it's nearly as soon as a lot of people think it's going to be. But forget about that for now. Even if they stop here and remain flat for a while, typically, after the last rate hike, then it takes them about anywhere between 10 and 12 months to start lowering rates. But bond market rates are going to move well in advance of that. But here we're focusing on the stock market and what happens to certain factors after that the Fed is done, basically. And so you see here on the left-hand side, you got quality stocks that tend to outperform the broader market in that environment, because when you think about it, the Fed has stopped raising rates, but they've raised them enough that in a lot of cases it kind of nudges the economy towards a recession, and then the economy slows, and so you've got these quality stocks that are naturally or intuitively going to outperform for a number of years thereafter. And so that's obviously something that we have on our mind that we're focusing on. And then you see here when you get into other factors like dividends and low volatility here on the right-hand side, that what you're trying to do is to minimize your downside capture in a market that might be going down because of recession. And so when you think about minimum volatility and dividend growth, those are two vehicles that will accomplish that. That they're going to capture less of that downside than would be the case if you had other things in your portfolio, namely growth. And talking about growth, we've got growth versus value. I went ahead and put this entire chart on here. It's an educational piece from BlackRock, which always does a great job. So looking at the left-hand side, for many, many years, going back to our parents' generation, value consistently outperformed growth. And, you had a lot of high dividend paying stocks. You had the Nifty 50, you had all of those blue chip dividend payers. And then, then came the tech revolution, and then we had Microsoft, and then we had Dell, and then we had these high flyers, and then obviously that pushed us, changed that whole calculus towards the end of last century with the tech bubble, as you can see here in February 2000, that you had a major outperformance by growth stocks for multiple years, and then you hit recession and then a bear market, and it all changed for a number of years, and it basically was exacerbated in the global financial crisis. And since then, we've had this resurgence or renaissance, if you will, in tech stocks, but we've had a bit of a catharsis over the last 6 months or so, and actually 6 to 9 months, I'd say. And so, we've had a value kind of, take up the reins again of leadership. But, I bring this all up to say not necessarily, well, you got to be growth versus value, but just to highlight the data. And on the right-hand side, you can see following these, very, important junctures. And of course, November 39 was, at the very tail end of the Great Depression, that we were improving, and then Fed raised rates too soon, and we went back into recession, blah, blah, blah. But you can see that value in each of these cases will outperform growth. Generally speaking, again, these are 3 data points, but that value is outperform growth after you have a peak in the outperformance of growth versus value. So again, this is not talking about when the Fed stops raising rates. This is saying that after you have these peaks where growth is outperforming value to an extreme amount, that typically after that you have value that is going to outperform growth over the next 10 years. And so that is the case that's kind of being made in this chart. And again, that doesn't sound sexy. It doesn't, people that own NVIDIA, that love that roller coaster ride, look at this chart and they just kind of yawn. But, again, if you're building portfolios for long-term horizons, for retirements that are out on the, well out on the horizon, you got to pay attention to these things. And so, you just want to construct portfolios that are, systemically strong, that recognize, what the market's giving you. Obviously the peak, we had an interim peak here in, May of this growth versus value. And so the idea here is that over the next, handful of years at least, that it pays to have some allocation to the capital strength, to that factor, to dividend growth as a factor, not necessarily forgetting, that you have these bouts of time, like literally over the last 2.5 months, where we've had this massive outperformance by these high-flying tech stocks. That tends to be a very volatile strategy, and if you're trying to achieve a high percentage and probability of success in your financial plan, the last thing you want is to introduce more volatility. And so I thought this piece was educational from that regard, and it just kind of helps remind us as practitioners that we need to remain steadfast in our approach and not succumb to the news flow. Well, that's all we have this week. Hope you enjoyed the chart pack. Have a good start to your month of June, and we look forward to talking to you again soon. Take care. Bye.